I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make you a little money. My job is not just to entertain, but to explain. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. When interest rates go up, even if they go up just a little, you can see lots of very good, well-known stocks with juicy dividends just get pummeled. Right now, some amazing stocks, some amazing companies are just getting thrown out with the proverbial bathwater. There's just one problem. Plenty of not-so-amazing stocks get hit, too, and they deserve to have their stocks go down the drain. You need to avoid those like the plague, which means it's very important to know, well, how do you tell the difference? So on a decidedly mixed day where the Dow dipped 89 points, but the S&P advanced 0.10% and the Nasdaq gained 0.72%, should you consider going against the grain to buy something that's totally out of fashion right now, but may not stay that way, particularly if you have a slowdown? Do you want to buy the stock of, let's say, a red-hot CoreWeave, a big and after hours? Or maybe buy a tried-and-true, well-known company with a very nice dividend? Oh, it's a tricky situation because we're taught to like value with income, but the stocks that have both value and income right now are getting slaughtered. While aggressive growth stocks, they're soaring. Why are the stocks of the tried-and-true companies getting crushed despite their solid dividends? Oh, there are a host of reasons. First and most important, interest rates are going higher, specifically the 10-year Treasury. It's a fierce competitor to these stocks, and the yield crossed 4.5% today. That's the magic number where investors say, ooh, I like that piece of paper. Solid yield, no risk. Get me out of stocks that yield about the same and into the bonds. Second reason why these stocks might be dangerous, government. We got a wild card Department of Health and Human Services, Bobby Kennedy Jr. We don't know whether he's for or against the companies he's regulating, probably against. And we don't know if he has the authority to do anything real negative, but he sure has the purview to look at them. So with those two caveats in mind, let's get started with the stocks that sold off hard today. Because I think it's really important because you know most, if not all, of these companies. Why don't we start with Bristol Myers, which we own for the Charitable Trust. Now, here's a drug company with a decent oncology franchise that happens to be facing what's known as a huge patent cliff, all right? Meaning it's about to have some highly lucrative drugs lose their patent protection, therefore not make them much money at all. We own it in part because of the yield. They're paying you to wait for new drugs that turn things around. The chief one is Cobenfy. It's a potentially revolutionary drug that treats some tough neurological problems, including schizophrenia. Now, we sold some of this stock when it had this ridiculous spike right here. It was some bizarre rotation into safety, but now Bristol's in the mid-40s. Now, we haven't bought back all of the stock that we sold. We're waiting for it to bottom because this most recent study is using Cobenfy. It's one study. It came up snake eyes. Management has said over and over again that it can pay the dividend, which gives you a 5.6% yield. Why not buy more? Honestly, because I think it can go lower still without evidence that Cobenfy is doing better. Or how about one of my absolute favorites right here, too, AbbVie. Now, here's a drug company with no patent cliff in sight whatsoever. It's got tremendous franchises in neurology, oncology, immunology, and medical aesthetics, among others. Because of today's vicious bond market-inspired sell-off, this fine stock's down a quick 10 points today, or more than 5%. But it only yields 3.7%. With rates going higher, you have to wonder if AbbVie's worth the risk, even as it's among the safest, if not the safest stock in the group because of these amazing franchises. I think it makes a ton of sense to start a position in the stock right now, if only because of the amazing Skyrizi and Rinvoq immunology drugs, as well as Botox, which right now is sainted for those who get too many wrinkles as their skin sags from taking GLP-1s. Those are the drugs that combat obesity and diabetes. I don't know. Tempting. Or let's consider Johnson & Johnson. AAA balance sheet. Many drugs in the pipeline. One of the best-run companies in America, if not the world, with perhaps the most billion-dollar franchises of any pharmaceutical company I know. But J&J only yields 3.55%. And it's got this terrible legal overhang related to allegations that its talcum powder, no longer on the market, caused ovarian cancer. We don't know how open-ended the claims are. Can you tolerate that risk? I'd love to say just go buy J&J, but where? What price? That yield is no longer enough to compensate you for the risk, especially if you don't know if RFK Jr. just likes some of their drug delivery mechanisms and formulas. So people are staying away from that, too, not just because of the bonds. J&J, hell, 3.3%. I've always believed that there are two consumer packaged goods companies that make a ton of sense whenever they go down, and that's Procter & Gamble and Colgate. Now, the former is the most unassailable consumer product lines in the world. Procter is also what we call a dividend aristocrat, increasing its payout by a little more each year for more than 70 years. Procter is such a winner. That is an amazing record. But here, at $158, and again, we're focused on Procter & Gamble, less than 2 points from its low, approximately 22 points from its high. I mean, you might be thinking, how can you miss? Easy. You can miss because Procter only yields 2.68% at these levels, despite all those dividend boosts. Well, that's just not enough to compensate you for the risk. Colgate's worse. Again, 2 points off its low, more than 20 points from its high, with amazing toothpaste and pet food businesses, among so many others. But it only yields 2.37%. So why can't you buy it here? Could go lower. How does it bottom? Then let's go food. PepsiCo is, by all standards, an amazing company. Worldwide franchises in beverages, snacks, while its beverage business has a formidable competitor in Coca-Cola, their Frito-Lay snack business, well, come on, it's the best in the world. I've never seen this stock so from its high. It's at $128, down from $183. It's down to the point where it yields roughly 4.4%. But what happens if the Secretary of Health and Human Services goes after the snack business for excess salt? I don't know, because it can have excessive weight if you eat too many of them, like what else wouldn't? Or maybe he says that soda has to be a natural color, whatever color that is. Does 4.42% in yield protect you from that? Obviously, today's sellers don't think so, but this company's worth a lot more than it's selling for. I just don't know when it stops going down. General Mills, which makes top drawer pet food. Let's go over that one. Incredibly popular cereals. You know them. Trix, Lucky Charms, Fruity Cheerios. When you were a kid, was there anything more fun than eating these for breakfast? I mean, they're practically addictive for children. Even for adults. I had some last week. And that's the problem. Bobby Kennedy Jr. wants to demagnetize these cereals as well as make many other products that have artificial coloring that kids can't resist. The question becomes, what if he gets his way? Will kids eat Lucky Charms without those colorful hearts and rainbows? Can you imagine if you took the color out of Trix? It wouldn't be for kids. This stock's 1 point off its low, 22 points away from its high, yields 4.5%. 4.5%. Let's think about this. General Mills now yields the same as the 10-year Treasury. If you're nervous, if you fear Bobby Kennedy Jr., would you fear the 10-year? Nah. But you know what? You might fear General Mills. So why buy a company that could be in the government's crosshairs when you can get the equivalent yield from something that's backed by the full faith and credit of the same government that might be coming after them? I am tempted to buy General Mills, but I do fear Bobby Kennedy Jr. more than I care about how much I might make with this stock. So here's the bottom line. In a very uncertain tape for what used to be called safety stocks, I'd rather just own a piece of paper like the 10-year Treasury, where if worse comes to worse, at least I get my money back. Howard in Maryland. Howard.
Hi, Jim. How are you?
I am real good, Howard. How about you?
I'm laid up, but that's why I'm calling you. I have invested in Lockheed Martin for some months, and since some influential person knocked it and said that drones were better than the F-35, the stock hasn't performed too good. No. I'd like to know if I should buy more, hold it, or sell.
Okay, so Jim Cramer runs this company, and he's a terrific, honorable, good guy. It now yields almost 3%. You can say, well, that doesn't compensate, but it only sells for 16 times earnings. I think Lockheed Martin, you start a position right here. I would have no problem buying a stock that Jim Cramer is in charge of and that sells for only 16 times earnings. All right, this tape has turned safety stocks upside down, and I'd rather actually, at this point, unless it's really big in yield and it's safe, own the 10-year Treasury, where I can at least get my money back at the very worst. Mad Money tonight. Can cadence keep climbing alongside the market? I'm getting the read of the AI infrastructure space with the company's top brass. That is ready to buy at these levels after today's monster move higher. I'm searching for answers, telling you where I stand in the stock. And could the latest headlines from Washington Post headwinds for the drug distributors? I'm going to take a closer look. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
The moment we stopped worrying about tariffs, the AI infrastructure stocks came roaring back. And some of that's because this business never went away in the first place. Take Cadence Design Systems. This is a software company that helps design semiconductors and other electronics. By the way, it's a key partner of NVIDIA, but along with many other players in the AI ecosystem. You know, there was never anything wrong with this business, but the stock got whacked when the AI trade went out of style in January, and it got whacked even harder after the Liberation Day tariff announcements. They have very little China here. Wait a second. Then Cadence bottomed along with everything else, and now it's rallied heavily from its lows. Doesn't hurt that the company reported a terrific beat and raise quarter at the end of April. So can it keep running? Let's check in with Anirudh Devgan. He is the president and CEO of Cadence Design Systems to find out more. Dr. Devgan, welcome back to Mad Money.
It's great to be here, Jim.
First, it's been a couple years since I've seen you, and it's been spectacular years for Cadence, including the most recent quarter. What is the reason why you've had such strength throughout this period?
First of all, I'm really appreciative of our customers and partners. We have great collaboration driven by this AI supercycle,
Right.
Because we are essential to the design of AI, and then we use AI to improve our products and have new products. And the other thing is we are a recurring software business, so with high backlog, and we are essential to the design of products. So we delivered a fabulous quarter in Q1. We are up 23% revenue and 34% EPS. So.
Now, let's take the case of NVIDIA. We often talk about Blackwell. And I think there's this perception that people say that, okay, so what happens is Jensen Huang develops this great product, and then he sends it to Taiwan Semi, and they make it, and that's what we have. Unfortunately, that's not the way it works. They are partnered with you, and without you, I don't know if they could make it.
Yeah, we have a great partnership with Jensen and NVIDIA. And I think Jensen has said publicly that they can't design Blackwell without Cadence products. At the same time, we use, their products, their AI and their accelerated compute to come up with new products. So a great example recently, last week we announced Millennium M2000. It's a new class of product. It's like an AI supercomputer. It uses our software, optimized for Blackwell and NVIDIA AI to create digital twin for entire industries, for chip design, for 3D IC, for system design like cars and planes, right. And even for drug design. So it gives up to 80x speed up in performance and 20x lower power. So it enables a new class of applications with NVIDIA together.
Well, no, this is a good example. I think it would take too long to do most things without that. If you're doing it 80 times faster, what would have been, how many weeks or months would it have taken before the supercomputer?
And some of these things are not even possible. We have endorsement with customers that, they were running only few cycles. They need to run thousands of cycles to verify a chip, but they were only running 10 and 20 cycles. So some of these things were not possible before. And that's for chip design, but also for system design like planes and cars and drones and robots. So the whole industry needs to be done virtually in the computer. And for that, you need a very accurate digital twin, which is what our products like Blackwell-powered Millennium and Palladium allow that to happen.
All right. Now, in one of your most recent conference calls, this was actually in Q1 25, this most recent one, you have said, we haven't seen any shift in customer behavior at this time. There seemed to be a perception that there was some sort of shift. How'd that happen?
No, we are primarily software business, so we don't see any change in customer behavior. Also, we are not directly affected by tariffs. So our Q1 was very strong. So as a result, not only we reaffirm guidance, we beat and raised our guidance for the year. So right now, these things, as take multiple years to design. We are part of the R&D cycle. So the customers are innovating for products that will be released years from now. So they continue to invest in R&D and they continue to invest in cadence.
I want people to understand that there is a difference between R&D cycle and actual making of hardware. They're very different. One is very long range and doesn't get canceled. The other periodically does. So when you say R&D, please explain to people how different that is from some of the other things.
Exactly. So when we mean R&D, this is the design of these products, not the manufacturing of the products. And this design of the like all industry, all customers have to add AI into their products, change, whether it's phones or it's cars with self-driving or with physical AI, with robots, of course, in the data center. So, and these things are essential for their future business, and we are essential to design these things. So, as you know, around us, almost everything has chips and electronics in it, and almost any chip designed in the world today uses some form of cadence software. And these these products are essential for our customers, so they continue to invest, and it's accelerating. The AI cycle is accelerating, not just with data center and agentic AI, but now with physical AI, with biosciences. So we see a lot of demand.
Business, absolutely.
Yeah.
Now, a couple years ago, I saw you, I believe it was on a dais, when a man by the name of Lip-Bu Tan won an award. The Robert Noyce, one of the founders of Intel, legendary figure, and you were there because he was a predecessor at Cadence.
Yes.
Now, I've noticed he's now running Intel. I've had the pleasure to meet him. I don't think you do all that much business with Intel, but I think that you might be an answer for some of Intel's admitted problems. Have you had talks with Lip-Bu? Do you think that could be a good partnership like you have with NVIDIA?
Yeah, I mean, first of all, I'm really happy that Lip-Bu is CEO of Intel. And I think he has said publicly that Intel needs to do better, and especially have an engineering-focused culture. And he knows how well we have done with other companies. And we are glad to partner with a lot of leading companies in the world, So I think we can help Lip-Bu and Intel to change its kind of engineering discipline, engineering culture, because you need state-of-the-art products to really succeed. I think Intel needs to focus on its core business, and Lip-Bu knows that. And our products make the design easier, is better with AI, the PPA, the power performance can be better. So we look forward to working with Intel on that.
Excellent. Now, one last question. People need to know, we emphasize NVIDIA because everyone's mentioned NVIDIA, and I just mentioned Intel. But the plethora of clients, you are not all your eggs in one basket at all, correct?
Yeah, we are very diversified. But at the same time, we are working with all the leading companies in the world, and also in all geographies. That's the key thing about Cadence. We are in all geography, in all industries, all the leading companies. And of course, we cherish these partners, these leading companies that are driving the industry. And the second thing, like I mentioned, is we are essential to the design of, we're part of R&D. And third thing is our business model. It's a ratable business model, high gross margin, high operating profit of 44%.
Always, everybody knows, you never miss on the margins. Well, you don't miss. I mean, well, look,
There's a lot of hard work. I'm really proud of our team.
I know, but you do a great job.
We have a fabulous team.
Well, by the way, we should mention that, we're up 60% since I saw you at the CNBC CEO Council?
Exactly, yeah.
Well, you could do a lot worse than that.
Yeah.
I want to thank Anirudh Devgan. He's the president and CEO of Cadence Design Systems. There's a quick video if you ever want to go. There's actually a bunch of videos on the site that really help explain in depth some of the things I just talked about, including the billions of things you put on in something like this. I don't know how you do it, but I know you do it. Mad Money's back after the break.
Coming up, Cramer's eyeing a stock that's been downvoted by this market. But is it a buying opportunity? You will need to find the right subreddit to find out. Next.
So many stocks have made incredible comebacks over the past few weeks, but there are still plenty of names that are way down from their highs earlier this year. Take Reddit. That's the popular online message board that's one of the top 10 most visited websites worldwide. While the stock's short 11% today, it's off more than $100 from its February peak of $230 and change. I think it might be a buying opportunity here as long as you steel yourself for a potentially wild ride. It is a wild trader. See, 2 weeks ago, Reddit reported the stunning quarter, but the stock didn't get any credit for it at all. It was in the Rodney Dangerfield zone. It got no respect. These guys delivered a phenomenal top and bottom line beat, 61% revenue growth, far outpacing their 19% increase in expenses. So not only is Reddit growing like crazy, they're also keeping costs down, and that translates into profitability. They earned 13 cents per share. Wall Street was only looking for 2 cents. Imagine 13 cents, they were looking for 2 cents. And this was their third straight quarter of unadjusted profits. Now, despite all the hand-wringing about how a softening economy might hurt the advertising market, Reddit's management sounded very confident about the future. They gave strong guidance for the current quarter, talking about 50% revenue growth at the midpoint, 200% growth for earnings before interest, taxes, depreciation, and amortization. Wow. Now, you'd think the stock would have taken off on those numbers, right? But despite initially surging 18% in after-hours trading, Reddit stock finished the next session down more than 4%. Why the heck did people sell this stock on such a seemingly strong number? When you look at the excuses the bears came up with, frankly, I think the selling is wrong. Totally absurd. For example, for the first time since its IPO, Reddit's revenue growth decelerated. 61% growth may look great, but that's down from 71% growth in the previous quarter. I say, are you kidding me? Reddit only grew at a 48% clip in the first quarter of 2024. That 61% number is phenomenal. What else? While daily and weekly average users both grew 31% year over year in the first quarter, some analysts worry that additional growth might be harder to come by. CEO Steve Huffman, known as Reddit, kind of affectionate as Spez, no accounting for taste there, noted that daily active users through the month of April were, quote, growing in the high teens range year over year, end quote, which suggests that the growth rate is slowing. These are the same fears that sent the stock down from its highs back when they reported an emphatic beat and with strong forward guidance in mid-February. Now, again, I think it's nuts. Most companies would kill for that growth. Management's being cautious with its user forecast. Why? Because Google keeps changing its search algorithm, which is a major driver of traffic for any website, especially Reddit. Some of these changes are subtle, but others are more visible, like the recent introduction of AI-generated summaries that attempt to answer queries directly. And let's face it, sometimes inaccurately. All this is in flux, so it's hard for Reddit to predict how many eyeballs they can attract via search. Now, lots of people are actually skeptical about this Google algo issue, but as someone who started a website, TheStreet.com, back in 1995 and relied on Google for a lot of traffic the whole time, every time we seemed to be building up a full head of steam, Google changed its algorithm and crushed us. Oh, I would be furious at Google, but unlike Reddit, there was nothing organic we could replace it with, and I certainly nothing I could do with Google. I am not that worried about the Google hostage issue here because of a variety of draws that Reddit has. Management, for instance, reminded investors that Reddit's still the sixth most searched word on Google. They're just behind the word news and just ahead of the word Trump. Nice bragging rights, don't you think? At least till the president finds out. Now, management acknowledged that, quote, the search ecosystem is under heavy construction, end quote, and that the, quote, near term could be more bumpy than usual, end quote. Okay, that didn't read well. But Reddit explains that these fluctuations are simply a byproduct of their platform's open nature. As management noted, Reddit remains, quote, one of the last major platforms that doesn't require you to sign in to learn something, end quote. It's really one of the few sites that still has that old school internet vibe. I like that. In a world that seems increasingly dominated by fake accounts, AI-generated answers, and clickbait garbage, Reddit stands out as a place where you can get real answers from real people, especially for questions and scenarios that are too niche for traditional search engines, like different illnesses or different hobbies. Now, look, that's why the platform's thriving. But beyond that, Reddit's made huge progress on the business side. In the most recent quarter, their active advertisers grew more than 50% year over year, driven by increased impressions and improved pricing. The company highlighted strong performance across key industries like pharma, as I mentioned. And, people who are sick tend to congregate, want to talk to each other. I don't blame them, right? You want to kind of have that affinity group. Auto, telecom, finance. You want to ask questions? There you go, including, of course, Wall Street Bets. This is especially encouraging because after Reddit came public, there were a lot of worries about whether it could monetize its user base effectively. Management noted that roughly 40% of its conversations on Reddit are commercial in nature, underscoring its attractiveness to advertisers. The company also is testing something called dynamic product ads. Early results show that these ads deliver a 90% higher return on ad spend compared to campaigns run last year. Now, that's another sign Reddit's building a more sophisticated, high-performing ad performance. Reddit's also working on multiple product improvements aimed at enhancing the user experience, like improving, frankly, their, I got to say, not-so-hot search function, which really kind of bewildering, I find. That can bring in new users while also reducing Reddit's reliance on traffic from Google. The less they need to rely on outside search engines, the less we need to worry about the daily average user numbers being thrown off every time Google changes the darn algorithm. And they don't tell you they're going to change it. But the major initiative here is Reddit Answers, the platform AI-powered search tool, which has already reached 1 million weekly users. It began its global rollout last month, started with Australia and then the UK. Hey, speaking of international expansion, Reddit's aiming to become a truly worldwide platform with the help of its machine translation tool, now available in 13 languages. This international push makes a lot of sense when you consider that international ad revenue grew by an astounding 83% year over year. That's outpacing the 56% growth in the United States. What's even more compelling is the monetization gap. Reddit's average revenue per user internationally is just $1.34 compared to $6.27 in America. We'll talk about some significant room for improvement. Despite coming up on its 20th year anniversary, welcome to the club, Reddit's still in the early stages of monetizing its international user base, so I'm confident they got a lot of room to grow. And don't worry, there's another AI angle to the story. The company has entered into contracts with generative AI outfits like OpenAI, granting them access to Reddit's data API. The API provides real-time structured content from Reddit's vast archive of user-generated discussions. That is an invaluable resource for training large language models that power these high-tech chatbots. Oh my God, that is just a pot of gold. Management highlighted this in the conference call, noting strong demand for their data among AI companies. Now, this could be potentially a very high margin revenue stream. Some people think it would be the highest. I wouldn't be surprised if these deals keep coming. And as they are announced, this stock will go higher. In the end, there's a lot to like about Reddit. But even with the stock down huge from its February highs, it's still trading at 54 times next year's earnings estimates. Okay, it's not a crazy valuation, given that they're on track to put up 85% earnings growth next year. And remember, with Reddit, we're talking about unadjusted numbers. That's reasonable. But the bottom line, while I think Reddit's absolutely worth buying at these levels, even after today's monster move, stocks like these are only worth owning if you can stomach some serious volatility like we're having right now. Keep in mind, we're always one presidential tweet or whatever you want to call it away from these kinds of names falling out of favor all over again. That's why I say Reddit's a buy, but only if you've got the intestinal fortitude to stick around for the long haul. Let's take calls. Why don't we start with Tim in Kansas? Tim.
Hey, Jim, how are you this afternoon?
I am real good, Tim. Tell me how you are.
I'm great. Hey, I'm an IT professional and love Supermicro computers. I have 40 or 50 of them that are running, zero failures with them in the last 15 years. So I went and bought the stock when it was super dirt cheap, and it went up to about 120 bucks, and now it's in the dirt again, and it should I look at getting rid of it or
no? To tell you the truth, I mean, this one had some accounting issues. They do seem to be now long enough behind them that analysts are starting to recommend the stock again. It's relatively cheap versus the whole cohort. If you want to consider the cohort to be things like a CoreWeave or, of course, an NVIDIA, and I would tell you. It is more expensive than Dell. I do like Dell more, but I think you could do a lot worse as Supermicro. But let me tell you something. You've got more product knowledge than I do, and I like what you had to say. All right, I think Reddit is worth buying at these levels, but maybe not all at once, okay? Be prepared for some volatility in the stock if you're holding on to it. It's a wild one. Now, much more mad money at major drug distributors stocks. They've fallen from their recent all-time highs. I'm breaking down the post-earnings action, and it is very compelling. Then doesn't mean the stocks are compelling. Then I'm analyzing some spec stocks that have caught my attention and outlining my strategy for approaching these riskier names. You probably won't like it because it involves actually making money. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Is there any group that's more perplexing than the drug distributors? These stocks, namely Cardinal Health, Cencora, and McKesson, are seemingly perpetual residents on the new high list. Over the long haul, they're some of the best performers out there, and they've done great this year, as is pretty much always the case. And yet, doesn't it always feel like the drug distributors are just one bad day away from falling apart? Most of the time, that's because of vague, amorphous concerns that some type of regulatory crackdown will force them out of business, or at the very least, make them a lot less profitable. We saw an abbreviated version of this at the very end of last year when then-President-elect Trump talked about knocking out the middlemen in the pharma business. Nobody was sure exactly who he was referring to, but the drug distributors seemed like obvious targets, and the whole group got clobbered. But the stocks came roaring right back because Trump never mentioned it again. Until we started hearing rumors last week, rumors that came true a couple of days ago. Lately, we've seen this whole saga play out in miniature. Cardinal Health, Cencora, and McKesson have all reported just fantastic quarters over the past 2 weeks, pushing their stocks to new all-time highs. Then the president issued an executive order to bring down drug prices, and the whole group sold off. Of course, legally speaking, the White House can't set price controls on anything without congressional approval. But you never want to be on the bad side of the president, especially this president. So what the heck are you supposed to do with the drug middlemen here? Historically, no politician has been able to touch them, even though this seems to be one of the most hated industries in America. I think this time actually might be different, though. Before we get into that, let's not forget that the drug distributors are making fortunes right now. Cardinal Health turned in an excellent set of numbers 2 weeks ago with double-digit earnings growth, and Management put through a big boost in their full-year earnings forecast. Cardinal stock jumped 3% in response, climbing from 141 to 145, and it kept running for nearly a week after that, eventually setting at an all-time high of $154 just last Thursday. What a fabulous move. Cencora, the drug distributor formerly known as AmerisourceBergen, knocked it out of the park when they reported last Wednesday. The company posted a slight top-line miss, but monster 31-cent earnings beat off a $4.11 basis. Even better, just like Cardinal, Management raised their full-year earnings forecast substantially. Cencora has raised its 2025 earnings guidance multiple times since originally issuing it in November. That's what you really want if you're a growth manager. The stock jumped 4.7% last Wednesday in response to the report, setting an all-time high of $309 and change before settling a little bit below that level. The last quarter from the major drug distributors came from McKesson, and that was last Thursday night, which delivered yet another very strong set of numbers. Repetitive, isn't it? Like the others, McKesson had a top-line miss, in this case actually a pretty sizable one, but still delivered a significant earnings beat and gave a higher-than-expected full-year earnings forecast. In a vacuum, I think the McKesson quarter was strong enough to spark a nice rally for the stock last Friday. But we don't live in a vacuum, do we? And unfortunately, some external headlines had already begun to impact the drug middlemen at that point. See, while we were out last week, there were a number of negative headlines for the healthcare sector. Early on in the week, we got a bunch of leadership appointments at the Department of Health and Human Services. That's now run by Robert F. Kennedy Jr., not the most pharma-friendly guy in America. And now his leadership team at HHS isn't looking that pharma-friendly either. But the big negative development for the drug distributors came midweek when Politico reported that President Trump would be reviving an effort to dramatically cut drug costs by adopting what's known as the most favored nation pricing for Medicare. Basically, this would force drug companies to offer the government prices that align with the lowest prices paid for the same drugs in other developed countries. Wow. The fear was that this would lead to compressed margins for the drug distributors if the drug makers' customers suddenly had to charge much less for the drugs. Of course, margins go down. Last Thursday, the big three saw their stocks get hammered in response. And rightly so, because that report turned out to be true, as President Trump signed an executive order on Monday aimed at lowering drug prices, which included that most favored nation pricing language, while also proposing to let Americans buy drugs directly from the manufacturers. You know what that would do? That allowed them to cut out the middlemen. As a result, all the drug distributors are either flat or slightly lower this week, while the broader market continues its comeback. So that's the conundrum with these middlemen. Cardinal, Cencora, and McKesson are all doing incredibly well, but like I said before, there always seems to be a threat that they could be regulated out of existence. That's extreme, I know, but that's what's in people's heads. Typically, Wall Street worried that the Democrats will go after this industry, but now the Trump administration wants to target them too? What can you do about all this? Man, it's tough to say. Look, when I look at the drug distributors, they remind me of the floor brokers at the New York Stock Exchange, where I am right now. But back in the old days, when my hedge fund was paying huge commissions for reasons that were really, frankly, never quite clear to me, including the right to have a rebate for research. That was a good business for the brokers for a very long time, until the industry got increasingly digitized, and you just didn't need the floor brokers for that pretty much anything anymore, and that crushed the margins. Are the drug distributors at that point right now? I mean, you could argue they are after Monday's executive order on drug pricing, and more generally with the Trump administration's generally hostile view of the pharmaceutical industry. Now, I don't know. The comparison's apt. In fact, I think it's telling that many of the drug companies and the drug distributors haven't even gotten hit that hard this week after we got to look at the language in the executive order. This is not something that can happen without real battles in Congress and the courts, but the drug stocks were hurt today. But now that Trump has the drug distributors in his crosshairs, you better believe that will affect what people are willing to pay for their numbers. If you let's say you own these, okay? I don't recommend dumping them completely, but if you're sitting on huge long-term gains here, there is nothing wrong with ringing the register on a pretty sizable part of your position. And if you're someone who's putting new money to work, unlike even just a few months ago, I wouldn't allocate it to a group of stocks near their all-time highs that suddenly have huge political risk to their entire business model. Now, if you really want to own one, and I do like this one, Cardinal Health is the one to do it with because it provides a lot more value-added services than the others. Now, we've had Cardinal on several times, and I think they're doing some very innovative things. They are impressive. They're beyond middlemen. But the bottom line, no matter how well the drug distributors have been doing, I do not want to stick my neck out for an industry that now seems to be hated by both the Democrats and the Republicans. It seems like the only thing they agree on, doesn't it? There are so many potential winners in this market. I say, why take the risk? Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time to start with the lightning round. Chris Fast from Africa. Let me say in the stock started by sell certificate. No cost of rest on my staff person. Play this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Chris, about to start with Bill in Florida. Bill.
Hello, Professor Cramer. How you doing today?
I am doing all right. How about you, Bill?
I am doing great. Hey, Jim, I'm a first-timer here, and I've got to start by telling you that I really appreciate the priceless education that you provide for all of us every day.
You're
really
very,
help
very
make
kind.
me a more confident investor.
You're very kind. Thank you. Thank you very much.
Hey, Jim, I've had a position in this healthcare REIT for a few years now. I've had some decent price appreciation, but what's attracted me to it has been the yield. I'm getting 9% on my investment and would still get over 7% if I added to it today. But considering all the news about potential cuts to Medicaid, I'm wondering how concerned I should be about the safety of the dividend. Jim, what do you think about Omega Healthcare Investors, symbol?
I think you're right to be worried. Why? Because of exactly what you said. That's why I've always liked Ventas, because I think that Deb Cafaro can navigate through anything, but the yield is much lower. I don't want to reach for yield. I need to go to Andrew in New York. Andrew.
Booyah, Jim. I'm calling to pick your brain on Asteria Labs.
Okay, Asteria Labs is a company that is incredibly well run, that has tremendous growth, but like many other companies, that stock has come down in value. I actually think it's a good place to buy, given the fact that so many of these other stocks actually even have higher price to earnings multiples. Let's go to AJ in Florida. AJ.
Jim, the biggest booyah from Florida.
See, this guy is a fired up guy. He's not just having a normal day. He's having a great day. Let's go to work.
Jim, thanks for taking my call. I've watched it as a kid. I'm 26 now, new to investing. I'm calling about an ed tech company that's up 48% year to date, market cap of $6.7 billion, 16% increase in revenue year over year. It provides individualized, adaptive classroom tech, and now has a K-12 tutoring program. As a teacher myself, I know the gaps that need to be formed across the nation. I think this stock's going to take off. Tell me about LRN, Stride Inc.
I would tell you about it if I knew it, and I don't. So we're going to have to do work. I'm looking right now at Dr. Ben Stoto, and he and I are going to have to coalesce on this issue and find out the answer. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, you can't spell suspect without spec. Cramer's cautioning against chasing the big moves in the market's most speculative names. Next.
We spend a lot of time in the office watching speculative stocks like Palantir, the software and cybersecurity company, AppLovin, which places ads in mobile video games, or any of the quantum and nuclear stocks, the Rigetti Computing or Oklo. We constantly take a gander at Coinbase or Robinhood, Hims and Hers, Archer Aviation. Oh, and let's throw in Pony AI, the Chinese autonomous driving play. Of course, we also look at some of the so-called tech blue chips like Apple, Microsoft, NVIDIA, you don't get it, Dell, Meta. And we examine the behavior of those stocks, too. And lately, we've begun to wonder, can both of these very strong groups coexist? Think about it. Ever since the market bottomed back in the second week of April, we've seen huge moves in the blue chip tech stocks, but the much bigger moves have come from the distinctly red chip speculative stocks like the ones I just mentioned. And I have to tell you that a rally led by speculative stocks is a rally that is just not sustainable. These two groups are indeed antithetical. A frothy market is not one that you want to get excited about. So I wish that the buyers of the red chip, well, let's call them red chip, red hot names, would just cool their jets for a moment. Let the stocks come in a bit. But they won't. These specs just get bought and bought and bought and bought, no matter what the price, and on no news whatsoever. That is worrisome to me because the buyers are showing no discipline. Take Palantir. This is an exceedingly well-run company, very flamboyant CEO who really knows what he's doing. His company offers superior technology that can pay for itself almost immediately by making their clients more efficient and smarter. It's got a very strong defense business, the envy of the big iron guys. Palantir is expanding margins and incredibly fast growth, but the fact is the stock sells for 220 times earnings. That is ridiculously expensive. And just, of all the speculative stocks I just mentioned, Palantir is probably the cheapest. The traditional tech stocks I follow, on the other hand, are selling between 20 and 30 times earnings. But it just doesn't matter. Like the other speculative stocks, price seems irrelevant. The buyers only care that they're going up. Sometimes I think that's all the buyers know about the companies. If you were to watch the stock of Palantir, for instance, really watch it, what you see is the stock starts trading very, very early, usually around 4 a.m. I watch it like a hawk. Usually starts going up right around then and start being maybe 80 cents, and then it'll be $1.20. A few minutes later, it might be at the $2 and then $2.50, and it stays up around $2.50, sometimes jumping up to 3 or 4 points once the actual market opens. Palantir is the most egregiously successful of these speculative stocks. And I say that because it roars even when nothing's going on. When the company last reported, it looked like the stock might actually be done because the international business wasn't robust. But management disabuses of that notion with some wildly promotional verbiage. The stock quickly shed 15 points, and then it was right back up as if nothing happened at all.
House of pleasure. This
morning I said that Palantir is going to $200, and that is up 70 points from here. I do not want you to laugh at me. When it was at 50, I said it would double, and it did. Why am I so confident? Because the buyers, whoever the heck they are, just won't quit. They are totally insensitive to price. By the way, same with the buyers in Pony AI, up 318% from its lows set about 3 weeks ago, and Hims and Hers, up 155% from its April lows. Anything nuclear or quantum just keeps rallying. Doesn't even matter what's said there. What's wrong? Look, usually a couple of things happen when speculative names catch fire like this. First, there are no real expectations now for many of these stocks, so it doesn't matter when they report. But soon enough, they'll be heavily covered by analysts, and then there will be disappointments, and that does matter. And then, second, the insiders aren't stupid. They start dumping stocks like mad when the stocks get too high. Third, the buyers tend to run out of gas right when the short sellers come in because the shorts know these stocks have run on very light volume and can be knocked down with heavy short selling. That could beget real sellers, real scared sellers, that is. I have nothing against speculation, but when you play with these stocks, you have to ring the register before you get hurt, because eventually someone always does get hurt. I can't tell you when that hurt will occur. Maybe it never occurs when it comes to Palantir. I can tell you this, though. If you own one of these speculative stocks, you know what? Do this for me. Trim some. Take as much of your basis out as you can, then let the rest run. Play with the house's money. Take some profits, because I'm betting you that you won't regret it. And I think, you know what? You'll thank me in the end. I like to say there's always a bull market somewhere. Promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.